Most people think about taxes only when the filing deadline gets close, but the smartest financial move is planning long before tax season begins. Tax minimization is not about hiding money or taking risky shortcuts. It is about understanding how the system works and using legal strategies to reduce your taxable income. The difference between reactive taxpayers and strategic planners can easily be thousands of dollars every year. One of the most powerful tools available to employees is contributing to retirement accounts. When you contribute to a traditional 401k, that money is deducted from your taxable income. If you earn $120,000 and contribute $20,000, you are taxed as if you earned $100,000. That reduction may even push you into a lower tax bracket. Over time, this not only reduces taxes today, but also builds long-term wealth for self-employed individuals. Options like a SEP IRA or solo 401k allow even higher contribution limits, creating a strong opportunity to reduce taxable income significantly. Health savings accounts are often overlooked, yet they offer one of the most powerful tax advantages available. Contributions are tax-deductible, the funds grow tax-free, and withdrawals for qualified medical expenses are also tax-free. This triple tax advantage makes HSAs incredibly efficient. Many financially savvy individuals treat their HSA as a supplemental retirement account by paying current medical expenses out of pocket and letting the HSA grow for the future. Investors can also use taxless harvesting to reduce their tax burden. If you have investments that gained value and others that declined, you can sell losing investments to offset gains. For example, if you gained $10,000 in one stock but lost $6,000 in another, you are taxed only on the $4,000 net gain. This strategy is commonly used near the end of the year and can meaningfully reduce capital gains taxes. Another smart move is reviewing your withholding early, rather than waiting until filing season. Many people celebrate large refunds, but that refund simply means you gave the government an interest-free loan throughout the year. Adjusting your W-4 properly ensures you keep more money in your pocket each month instead of overpaying and waiting for a refund. Understanding deductions versus credits is essential. Deductions reduce your taxable income, while credits reduce the tax you owe, dollar for dollar. Credits are generally more powerful. Education credits, child tax credits, and energy efficiency credits for home improvements can dramatically lower your final tax bill. Many homeowners miss out on available incentives for installing energy-efficient upgrades or electric vehicles. For business owners, documentation is everything. Legitimate deductions include home office use, software subscriptions, marketing, costs, mileage, and certain travel expenses. However, without proper records, these deductions can be disallowed. Using accounting software year-round instead of scrambling during tax season prevents costly mistakes and missed opportunities. Timing income and expenses can also be strategic, especially for self-employed individuals. You may choose to delay invoicing until January to shift income into the next tax year or accelerate business purchases into December to increase deductions for the current year. This flexibility allows you to manage taxable income more effectively. Charitable contributions can also be planned strategically. Instead of donating small amounts annually, some taxpayers bunch multiple years of contributions into 1 year to exceed the standard deduction threshold. Higher income individuals sometimes use donor-advised funds to maximize tax efficiency while maintaining charitable impact. Holding investments for longer than 1 year can reduce capital gains tax rates compared to short-term gains, which are taxed at ordinary income rates. This is particularly important for active traders and real estate investors. Simply holding assets slightly longer can lead to significant tax savings. The most important lesson is to consult early. Tax professionals can provide the greatest value before the year ends, not after it closes. Once the calendar flips to January, most tax-saving opportunities for the prior year are gone. Proactive planning is what separates average taxpayers from those who consistently minimize their tax burden. As the end of the year approaches, smart taxpayers begin reviewing their financial position carefully. December is not just holiday season. It is one of the most important months for tax strategy. Strategic decisions made before year-end can significantly lower your tax bill. One of the most powerful tools is deciding whether to accelerate or defer income. If you expect to be in a lower tax bracket next year, deferring income such as bonuses or business invoices into the following year can reduce taxes. On the other hand, if you expect higher tax rates in the future, accelerating income into the current year may be beneficial. The key is anticipating future changes in your earnings and tax environment. Business owners can benefit from Section 179 and bonus depreciation rules. which allows certain equipment and vehicle purchases to be deducted immediately instead of depreciated. Over many years, timing these purchases strategically can create substantial deductions in high-income years. Buying necessary business equipment in December rather than January can shift thousands of dollars in tax savings. Real estate investors often use cost mitigation studies to accelerate depreciation. This creates paper losses that can offset other income. Many high-income earners use rental properties specifically because of the tax advantages associated with depreciation and expense deductions. Roth conversions can also be powerful. If you experience a temporary drop in income, converting funds from a traditional IRA to a Roth IRA allows you to pay taxes at a lower rate now and enjoy tax-free growth later. Timing this conversion correctly can lead to significant long-term benefits. Estate and gift planning should also be reviewed annually. The annual gift exclusion allows you to transfer a certain amount of wealth without triggering gift taxes. Families who plan early can gradually move assets while minimizing tax exposure. Changes in exemption limits make this especially important. The qualified business income deduction allows many business owners to deduct up to 20% of qualified income. However, eligibility depends on income thresholds and business type. Understanding these rules before year-end can help you structure income properly to qualify. Capital gains planning is another area often ignored. If your income is unusually low in a given year, you may qualify for the 0% capital gains bracket. Selling appreciated investments strategically during such years can eliminate taxes entirely on those gains. State taxes should not be overlooked. Residents of high states may benefit from understanding residency rules or timing moves carefully. Some entrepreneurs relocate specifically for state tax efficiency, but this requires careful documentation and planning. Estimated tax payments must also be reviewed. Underpayment penalties can accumulate if quarterly payments are insufficient. Ensuring compliance prevents unnecessary penalties that erase smart planning gains. Finally, staying updated on new tax rules is essential. Changes to retirement contribution limits, energy incentives, and business deductions occur frequently. Being informed allows you to adapt quickly and take advantage of new opportunities. Tax laws change constantly, and adapting to those changes is essential for long-term financial success. Inflation adjustments can shift tax brackets each year, affecting how much of your income is taxed at certain rates. While these adjustments may reduce tax pressure slightly, changes in credits or deductions can offset those benefits. Staying aware of these updates ensures you do not miss opportunities. Energy and environmental incentives continue to expand. Tax credits for installing solar panels, purchasing electric vehicles, or upgrading to energy-efficient systems can reduce taxes significantly. Timing installations properly within the tax year ensures eligibility. Digital assets now face increased reporting requirements. Cryptocurrency investors must track cost bases accurately and report transactions properly. Failing to report digital assets can lead to audits and penalties. Organized record keeping is critical. IRS enforcement has increased in certain areas, particularly among higher income taxpayers and complex returns. Large charitable deductions, repeated business losses, or aggressive home office claims may attract scrutiny. Maintaining documentation and reasonable reporting reduces audit risk. Technology is transforming tax planning. Modern accounting software and AI-powered tools allow real-time expense tracking and tax forecasting. Instead of waiting until April, individuals can estimate their tax position throughout the year and make adjustments proactively. Multi-income households face additional complexity. Side businesses, freelance income, and investment earnings require structured bookkeeping. Separating accounts and maintaining clear records prevents confusion and errors. International income adds another layer of responsibility. Individuals earning income overseas or holding foreign accounts must comply with reporting rules and may qualify for foreign tax credits. Failure to report foreign assets can result in severe penalties. The most successful taxpayers review their strategy quarterly. They ask whether they can reduce taxable income, shift earnings, or optimize deductions. Tax planning is not an annual event. It is a continuous process. Building a professional tax team becomes increasingly important as income grows. A CPA, financial advisor, and estate attorney can work together to create an integrated strategy. Tax efficiency is not about filing forms correctly. It is about designing a structure that minimizes tax over decades. Ultimately, taxes are one of the largest expenses most people will ever pay. Treating tax strategy with the same seriousness as investing or business growth can significantly increase long-term wealth. Proactive planning, consistent review, and professional guidance form the foundation of sustainable tax efficiency.